All right, everyone. Welcome back to a week in review. This week, 6/24/22. Um, just want to give apologies for the heads up as far as the quality of the video and the audio. Um, had a few issues, and then tried using iMovies. Long story short, a couple technical issues, but it's been a short week, so Monday was a holiday, as everyone knows. The markets are closed for Juneteenth. So we're going to do just a short video anyways, kind of give you guys a recap and kind of, like I said in the last video, wasn't going to be the busiest of weeks as far as information goes. It was going to be more in regards to markets processing and looking over the data from the prior week with the Fed and a lot of the heavy data that came in. That being said, there were a few events we're going to go over and look forward to next week when things start to pick up again. So, all right. So, I know a couple weeks ago, like I said, last week wasn't the busiest, but a couple weeks ago, a few things happened. You had record future contracts, and then you also had outflows for the first time in 7 weeks, which for those of you who aren't familiar, they actually measure as there's inflows going into investments and there's outflows. Typically, you tend to see things on the positive side towards inflows. The week of the Fed meeting was the first time in almost 2 months we had kind of seen outflows overtaking inflows. So you kind of had a little bit of that panic selling, and you had kind of people managing their accounts to hedging against downside risk. And just because of the sheer volatility of everything with the 75 rate hike and all that from a couple weeks ago, that week you also had a massive bear market in oil. I mean, you had basically a 20% drop in a week, and obviously that's gonna have effects. You had essentially $1 billion of in the money options basically expire worthless in the oil space. Now it's obviously not the entire market, and $1 billion is a very small portion of the entire equities market. So it's not like you're kicking over half the bucket, if you will, of value creation or destruction. But you did have a massive move in that kind of market as well. So 2 weeks ago with the Fed and everything, you had a lot of things going on, and then getting closer, basically recapping as far as this week has gone. You had Monday, the markets are closed. So you had basically a 4-day week. You saw a few data points come out. You have existing home sales that came out. They're kind of retreating to more normalized levels, but at the same time, you also saw prices increasing. You're now at 407,000 average for the home, and that's basically as corporations basically continue to purchase for rentals. You had last year corporations bought roughly 1 in 7 homes for sale in kind of major areas. With areas like Tampa and a lot of these hard markets being as high as 1 in 4. And I'll actually, if you guys want, in the video description down below, I'll put a link to the Washington Post article that kind of goes through all that. And that's well above the 5% national average. So you had a huge inflow of investment from corporations and investors that really caused an expansion in the basically average home price. And even as existing home sales kind of volumes started to normalize, retreat from the kind of record high levels you still had prices increasing. Okay. And I think that trend's going to continue to accelerate. Matter of fact, there's also a New York Times article, which again, I'll post in the video below if you want to do for your own reading. You have some areas like Charlotte and Atlanta that have seen 1 in 3 homes sold to corporations or investors. So as opposed to the historical market where you have roughly 5% being bought as investments from corporations, investors, etc. And typically what happens is you have an older retiree or someone's passed away, and then you have the new entrants, basically the new generation coming into the market and purchasing. They're typically the largest buyer. Well, what's happened over the last couple of years is with all of the QE and all the stimulus that started really in 2018, even really prior to that, you've had now corporations become the largest, starting to become the largest buyer, if you will. Right now, you're looking at roughly 30% in kind of these hot areas like Charlotte and Atlanta, etc. So even with a volume slowdown in sales, I see this trend continuing where you might have retreating volumes and less transactions, but I still see prices holding strong. And that's basically because until that corporate investor pulls out, they are now one of the dominant players in the market. And until they pull out, I don't see any subsiding from the actual housing prices themselves. And I mean, this is all basically the flip side of M2 expansion. For those of you who aren't familiar, M2 expansion is one of the ways the Fed looks at basically monetary expansion, or how many dollars are in the pool, the economic pool, if you will, right? So one way that the government tries to engineer things where you avoid recessions is basically they just, one way or another, provide more liquidity, or basically more dollars, just print more dollars essentially, if you will. And I mean, the end result of that is basically unaffordable essentials as people keep bidding and bidding to acquire those assets. And you kind of saw basically the beginning of 2016, this money supply was 12.4 trillion. At the end of 2021, so kind of like a 5-year snapshot, it was 21.7 trillion. So you're talking a massive increase there. It's almost doubling in a 5-year span. So during that process, a lot of these large investors, corporations made billions and billions of dollars, and now they're looking for different areas to invest in it. And housing has definitely become one of those areas that has drawn a lot of attention. And that now that's why you see, especially home markets, where they're making roughly a third of the buying. So I don't see that trend at all slowing down, where housing prices, I don't foresee them falling off a cliff. Beginning of this year, I said they'd probably be up first 6 months of the year and down slightly the second 6 months of the year. I still see that kind of playing out as these large corporations provide basically a floor for housing prices as they continue to buy them and use them as rentals. So that was kind of one interesting bit of data that came out. Existing home sales are always highly watched. You also had the stress test results for the banks, and that's after 2008, the Fed and policymakers basically came up with a way to manage existential risk, or risk to the entire system, through the banking sector specifically. And the government now mandates and controls how much capital or money that these banks have to keep on their balance sheet, or keep in-house, if you will, and in anticipation of something potentially going wrong, because they don't want, because of what happened in 2008, where you had Lehman and different Bear Stearns, and you had all these banks that were going bust. It provided huge stress on the financial system. Former Fed Chairman Paulson actually wrote a book about this, and so basically these test results are, you kind of know what they're going to come up with even prior to them being released, because the government continually basically monitors and requires different capitalization levels. So you kind of already know going in as to what they're requiring from the banks. It's just, and the other thing that kind of makes it almost comical to me, as far as a actual baseline of measurement, every year the way they run these tests changes. So they're constantly changing the rules. So you don't have historical data that you can go back against. And this year they increased total loan loss to 600 billion. They also increased unemployment in this hypothetical situation 10%, to basically say if these scenarios were to occur, then what would happen. So the principle of it, I think we kind of already knew the results, because the Fed again and the government has been monitoring the amount of reserves that they have to have available. But obviously it's a reassurance to the markets when you have those kind of situations basically being thrown at banks, and the government basically saying they are able to withstand that situation. The amount of confidence that the Fed and government instills in different investor, I guess, is palatable upon each investor. I know some kind of view this as actually a good measuring stick, and then others kind of think of it as a joke that the Fed is, even just going back to a year ago, they said their inflation was transitory, et cetera, and So the credibility, I guess, aspect is kind of dependent upon the individual's personal beliefs as far as of their reliability and system goes. But nonetheless, the actual results themselves, generally speaking, kind of had a calming effect on the market. You also had, which was a number I was kind of discussing, and if you listen to the last podcast a little bit, kind of a number that I was looking forward to. We did our last session of Sell the Rip or Buy the Dip, discussing oil related stocks and commodities. And then you had API crude stock, which is a measurement of how much inventories of oil have either grown or shrunk. And it came in with a 5.6 million barrel reading. And that basically was an increase of inventories of 5.6 million barrels. And if you look basically since April 3rd, we're trending at adding roughly 1.1 million barrels per report. And they do these reports weekly. So you've seen a steady growth in inventories, which is why specifically in the last week or two, you have begun to see oil as a commodity kind of roll over a little bit and gasoline prices come down slightly. It's because you're starting to see a build in inventories again. Now, that being said, this week you obviously had the SPI release, or the strategic reserve, the government releasing oil from the strategic reserve to artificially help depreciate those prices. And so that's kind of why you saw a massive reading at 5.6 million barrels for a week, which is very significant. And then kind of another positive surprise you had to help buoy the markets last week. You had the positive surprise for new home sales on Friday. So earlier in the week, you had existing home sales, which kind of showed things retreating. And then you had these oil number comes out and better than expected. So obviously as energy input cost comes down, it's kind of, especially at these elevated levels, kind of a little bit of a sort of windfall to these companies, as you will, as far as their input costs are going down, obviously. And then again on Friday, you had a positive surprise in new home sales. So you really saw the market begin off of the back, I believe, of those kind of two data points begin to rally. And then you also had, on Friday, you had a very key level at roughly 3,800. The market not only rallied and broke through that level, but it kind of rallied into the close as we broke through that technical level. And I think what allowed the market to do that was basically the crude prices coming down and these positive reports on the crude inventory, and then also the positive surprise on new home sales on Friday following kind of, I wouldn't necessarily say negative because it was kind of anticipated, but basically combating kind of like the existing home sales number earlier in the week. So you kind of saw a little bit of positive momentum and positive data points and information coming out towards the end of the week, and you saw people, especially now, I believe, are kind of skewed to the bear side, especially following the week with the Fed. And on Friday, you really began to see people kind of covering shorts and a little bit of positive momentum rallying and becoming self-fulfilling prophecy as a lot of bearish sentiment was kind of being corrected on the close on Friday, especially into the close. So that's kind of what you had going on last week. Looking forward to this week. We do have a few things going on in the markets. We have durable good orders, and I believe that number is going to be very important. And the reason I say that is, if you look at last earnings season, okay, so if you go back to some of the, especially the consumer names, Target, Walmart, etc., when these guys reported, they reported an issue basically in inventory management. So you had them saying that they did not anticipate very well their ordering and their inventory stock, which resulted in essentially a massive over ordering and all of these durable goods. You had some companies that had an increase in warehouse spacing being used by 40%. So you have this massive glut of inventory, and the reason the durable goods order as something I'm definitely looking at is because it's going to come out in the morning, roughly 8:30, and it's going to be month over month. So you have the basically the change month over month, and I'm really interested because a lot of these companies that came back and had these issues, are you going to see a significant drop off in durable good orders? Are you going to start seeing people saying we over order, we're not going to make that mistake twice? Or are people going to say, all right, that's one mistake we made, we're not going to compound it by making another mistake and not being short inventory again? Because as kind of as they commented in their actual earnings call, Walmart and Target both stated that it wasn't necessarily the consumers' will to spend or ability to spend, like they were still purchasing, the revenues were not bad. It was what they were buying, the companies mismanaged. They poorly anticipated what the consumers' desires were going to be. So it left them of too much of one inventory item and not enough of another. And that's why you saw Target on the day of the earnings drop 25%. You lost a quarter of its value overnight, essentially. It's very rare for a company that large, who generally executes very well, to do that. So, irregardless of what they say on the earnings call, the durable goods number is going to be a real indicator of not what they're saying, but what are they actually doing? What are these companies doing with their inventories? Are they really cutting back on what they're spending? Or, as they said on the call, this was our mistake. We're going to have to basically eat it because we bought too much of X item and the consumer really wanted Y. So we're going to have to heavily discount this item, but we still think in 3 months they're going to be purchasing Y. They can say that all they want, but the consumer durable good number is going to actually show what they're doing. So that's one key metric I'm looking at for the week to come. We also have earnings beginning. Okay, so kind of going on the back of what the whole Walmart and Target thing, you had companies double ordering inventory because their scarcity concern with supply chains, COVID, etc. You're going to start to begin to see serious earnings reported. You're going to start off with Nike on Monday. Now, as you guys know, Nike is a very premier brand. Personally, myself, when I go to shop, if I'm getting new shoes or a tire, especially athletic wear or something like that, I don't look elsewhere. I try and buy something quality. Nike, they're very well known. They have the cachet. So I think as far as the actual product goes, there's not really any concern. But just because it's a good product doesn't necessarily make it a good stock. People want to buy Nike today as much as they did a year ago. However, the stock is off 33% year to date. The numbers probably come down a little bit based off last week's momentum and kind of positive upside swing. But if you go back to, again, the same thing, their fourth quarter, they guided kind of downwards for this quarter, basically talking about China lockdowns and kind of the headwinds that they were facing. For me, what's interesting, you have at the very beginning of the week one of the most premier brands as far as consumer goes, and you're going to have them reporting. I'm not really necessarily looking so much at the number. They've already guided that down. Initially they were expecting 95 cents. Now they guided it down 10 cents roughly to 84.85. What I'm looking for, and I think this has more regard for not just Nike, but for other stocks like Tesla, etc., is what are they going to comment on as far as the supply chain and kind of the end markets, right? So they make a lot of goods in China and import them here to the U.S. So does Tesla, right? So even though they're kind of totally different inventories, these lockdowns and all this stuff, everybody from Taiwan semis to Tesla to Nike, all these guys have been affected. Some have handled it better than others, but at the same time, you're going to get a foreshadowing of truly the effect. Are they basically going to say the worst is behind us as far as logistics go? Or are they going to say that we continue to see potential issues, right? So that's really what I'm looking for on Monday. You have a massive conglomerate reporting, and you can get into also the consumer space as well. So aside from supply chain and obviously all these China lockdowns, all this, what are they going to be looking forward as far as consumer interest in the product? Like I said earlier, Nike's a premier brand. Nobody's going to go out and just switch from buying, Nike athletic shoes to buying, I don't know, Pumas or something like that. You might have the fringe buyer, but as far as the core market goes, Nike has, and will continue to have that market. So they really have a beat on the pulse of the consumer. So it's gonna be really interesting for me. Is this trend going to continue where you've seen a lot of airlines, a lot of cruise lines, etc., seeing a huge uptick in their products because during COVID, people were buying a lot of things, and now they're buying or trying to spend their money on essentially experiences and ability to interact with one another, etc. Is that trend going to continue? Is it going to affect Nike? Or do they see just a general slowdown in general? So that's really kind of one of the big headlines, especially because it comes at the beginning of the week. I think Monday, you're going to have people kind of just skirting around, kind of waiting on that report. And I think Monday night when that's released, that's going to probably move the markets one way or another for Tuesday. So on the back of that, you also on June 30th, you're going to have two companies I'm looking at, and that's going to be, one is going to be Micron and the other one's going to be Walgreens. Now, two completely different sectors of the economy. You have Micron that is in DRAM, so basically memory, chips, etc. They build, and they are a big player in the chip space. They're not NVIDIA, they're not Intel, they're not one of the biggest hitters, but they're kind of that next tier below. And the same thing, you've seen basically a almost 40% retracement up until kind of last week or so. You saw a little bit of forward momentum, and now you're looking at something that's roughly down 35% for the year. Is that going to be enough carnage? Is essentially what we're looking at now. You have guided EPS are expected to be great, $2.50 a share roughly. 246 is kind of roughly the analyst's exact number. So you're seeing a year-on-year basis increase of roughly 30%. Now, same thing, revenue, you're expecting 17% increase. Here's going to be the real kicker, getting kind of back to that whole Nike dilemma, if you will. When Nike reports on Monday, they're going to be discussing these goods that people double ordered potentially, and there's a build in inventory as people mismanage what they thought consumers might want. Getting back to the chip sector, is that going to carry over? Micron's one of the first big players in the chip sector to report. So are they going to see basically a pullback in demand because individuals were double ordering chips? I mean, as you remember, it was on the news every single day. Government even created a bill to give these companies billions of dollars for free to make more chips. So you had a massive shortage. And are you going to see the same effect that we saw with these retailers? The Teslas of the world, the Fords of the world, all these guys, even computer makers, right? Manufacturers. Because of the scarcity, the shortage of the products, did they double order? Did they make the same mistake that Target and Walmart made? And I think that's really going to come through in the commentary. I don't think that's going to be affected this quarter. I think their earnings are going to come in really well. The question is going to be, are they going to make a comment that we're seeing a slowdown in demand because of the same reasons that Target and Walmart are potentially reducing their demand for inventory because people over-ordered, double booked, etc. And I think that's going to be very key because as semis go, I think to some extent the market's going to go, right? As far as the technological society that we live in, semis are the beating pulse of that. You cannot have computers, you can't have any phones, you can't have any of these without the processing chips. So this is, again, going back to the consumer goods side, I think looking at Micron, you're now looking at what's going to be a foreshadowing of potentially the corporate inventory side of things. So Monday, Nike, you have consumer inventory and kind of the consumer demand. Thursday, you're looking at Micron, you're kind of looking at kind of corporate inventory and corporate demand. And I really believe that, again, on the back of these earnings, you're going to see kind of the markets really be affected one way or another. If guidance comes out in line and people say, no, we haven't seen any shortage, I think you're going to see the continued momentum to the positive side. If these guys come out and say, hey, look, we're really concerned about double ordering, we see headwinds. It's another word that they love to give on their earnings call. We see headwinds. I believe you're going to see a potentially pressure in the overall markets and kind of dragging things potentially to another leg lower. And then another one that I'm also looking at, we have Walgreens. Okay, so Walgreens is going to be the same day as Micron, and the reason I'm looking at Walgreens is because of a little thing we have called inventory creep. So that's a very polite way of saying that they're, one aspect I'm looking at is basically inventory loss due to theft. Now, typically, when companies report, they account a certain percentage of their profits to be written off as inventory loss due to theft. Um, for the first time in a while, we've actually the first time that I can ever personally remember. So if any of you listening can, write in and let me know when this might have happened before, but we actually saw a situation occur where potential theft was so high that Walgreens actually issued a warning about it being a serious threat to basically their earnings and their ability to basically make and maintain their profit margins. If you look at this specific week, or basically Walgreens, you're looking at roughly 92 cents. For the quarter is what they're expected to report. You have, again, this is going to be a drop. Unlike the previous two, you're looking, which were basically kind of flat to positive. These guys are looking at a drop at roughly 30% year on year. And another aspect they're looking at this is that's partially due to COVID-related sales, where the government was basically reimbursing them for giving COVID vaccinations out to people. And as those kind of slow down, those reimbursements and those incentives are going to slow down as well. I'm not really interested in that. That's kind of a done deal. Now going forward, how are they going to invest in that? And what are they going to say in regards to kind of creep? Because if the consumer doesn't necessarily have as much as they did prior, the temptation is obviously there to basically just steal what you can't pay for. And if you see an uptick in that, I believe it's kind of the beginnings of showing that maybe things aren't as healthy on the consumer front. And so Nike on Monday, and I think if these guys don't mention it, you're kind of fine. But if they kind of mention something in regards to inventory loss due to theft, I think you might, especially if the Nike report on Mondays and is positive, I think you might begin to see kind of a bifurcation in consumer-related inventory stocks, right? So something, Nike and Walgreens, very common items. Everyone can go purchase something at Walgreens and Nike, generally speaking. Something that's more of a high end, like a Gucci or, Coco Chanel. I think you're going to start to see potentially a bifurcation in those client base. I don't believe Coco Chanel and some of these higher end, potentially marketers and corporations are going to see as much of a hit to their earnings or their revenue streams. I don't believe that clientele is necessarily affected by higher gas prices. Really, quite frankly, I don't think it affects them at all. So that's going to be another thing that, combined with the Nike report, very interesting. Kind of keep your eyes on the commentary on those two. All right, so that was kind of what I'm looking for the week as far as major market movers and data points and key information to look at. So we're going to end, as we always do, with a little segment called Buy the Rip or Sell a Dip. And I'm looking at a few companies this week. The first one I'll get to, because we already talked about a little bit, is Nike. I personally would not be a buyer here. I think you can, if Nike gets to the 120 level on Monday, I think you're starting to hit major resistance. Now, from a long-term investor perspective, I think if you buy Nike here, if you're looking at a 5-year chart, I think this is a pretty solid entry point. That being said, over the next few months, I think you can get it cheaper. If you look at that 5-year chart, I think 100 is kind of the level that I definitely would want to see it hit before I consider selling, before I consider buying. And I think you have, again, resistance at 120. And I think on Monday, you're going to have a few issues heading into the report. You're going to have the fact that they're exiting Russia. So they're going to be permanently closing down lots of stores. Now, is it the biggest hit as far as the revenue component? No. Russia is a very small, as far as the revenue profile goes, Russia is a very small segment. That being said, right now we're kind of in a market where any sort of weakness that's being sniffed out, you're getting punished. I also don't think that they're going to guide particularly strongly heading into next quarter. I think they're going to exceed this quarter's numbers probably because I think the China concerns that they kind of overplayed their hand on that one and kind of artificially slowed things down and give them a little bit of breathing space for this quarter's earnings. So I think their numbers are kind of coming better than expected. I do not think that what they stay on the call is going to be very positive though. You have the Russia issue, and I think in general you're going to have European concerns as well as far as them being still affected by the war. So I don't think right now is a time to buy. I think right now is actually a time to sell, and I would not even consider buying until it approaches that 100 level. At that 100 level, it's kind of a wait and see where we're at as far as the overall market goes when it goes there. But I do not think right now is the time to be looking at purchasing. I think we have potentially another 10% downside in the name. Second one we're going to be looking at, and this name again has earnings as well, but I don't think it's necessarily going to be a market mover. I do think it is important though. It's going to be Paychex, symbol PAYX. Now these guys provide human resource and payroll assistance to small and medium-sized business. So I'm actually going to be watching this. I don't personally own any equity stake, full disclosure. These guys are going to have a very, very, very good pulse on the job and kind of overall Main Street economy, if you will. Most jobs are created from small and medium business. So go support your small and medium business in your area. And this is a company that is geared to providing them with the service they need for HR and payroll. And looking at the chart, I'll throw it up on the screen for you guys. I see 110 as kind of being the floor. I see kind of 135 as being a ceiling. I think you wait till about Tuesday or so. I think Monday, Tuesday, we might have a little bit of negative news baked in. And I definitely see, if you see 115 on this, I think you can definitely, the 113 to 115 level, buy it for a little bit of a short-term bounce. I believe they're a well-run company, and I don't foresee, a whole lot of negative momentum coming out of the earnings report. That being said, say you buy in at the 113 level, I think you put a stop order in at 106. If it goes below there, you don't have any significant support in the last year for any level below that. So again, I think at the 112, 113 level, I'm a buyer, and with a stop loss order around 106, so that way I know I can define my potential losses. If it breaks down below that, I think it's not going to be any smooth sailing for a while. And I would definitely take a profit order around the 135 level as well. I don't see, especially in this market where we're having things kind of grind lower, irregardless of news, and seeing massive short rallies, if you will, and not very sustained. I think if you get to the 125, 26 level, I would consider selling. And if you get to the 135, I would definitely take the money and run. So I'm a buyer of Paychex. And another third one we're going to be looking at this evening is Micron. We also discussed this earlier. I definitely think Micron, I'm a buyer. I'm definitely buying the rip. I'm going to buy it for the rip on this. You have a stock that is trading at essentially what is a 52-week low. Okay. In spite of the fact that their revenues year on year and profitability year on year has grown. If you look forward to the report, like I said earlier, they're almost expected to make $2.50 a share this quarter alone. Okay, annualize that, you're looking at a rearward PE of essentially 7 and a forward-looking PE that's even better. I don't see much more downside. Typically, these things go in cycles, just like oil and a lot of the commodities. And when they go up very violently, and they retreat very, very violently as well. That being said, these guys have roughly almost 10% of their entire market cap in cash, and they can use it for repurchasing stocks. Again, they're going to make another almost $2.50 a share this quarter. They have so much capital. I think that they can use that as kind of a put on the share price with share repurchases. And I kind of see that floor establishing, and I think it's going to break above 60, and then definitely it's going to approach, in my opinion, the 70 level. And when it hits 70, I think you kind of consider taking some of the chips off the table. That would be roughly, a 15% gain right there. So not too bad in a couple weeks. Definitely a buyer here. I'm buying it for the rip. I also don't see demand for the product slowing. Like I said earlier, AI, memory, USB flash drives, all these kind of memory storage, etc. in this kind of market they're in, I don't foresee necessarily evaporating overnight. All right, guys, have a good week. Everything stated on the show is obviously my opinion. Before doing any sort of investment, consult your own advisor, do your own research, use your own advice. You guys have a good week. Until next week.